Welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates. Securities offered through Peak Brokerage Services, LLC. Advisory services offered through the Retirement Guys Formula, registered investment advisor. America's Retirement Headquarters, America's Medicare Associates, and the Retirement Guys Formula are separate and independent entities from Peak Brokerage Services, LLC. Thanks so much for joining us today, and welcome into America's Retirement Headquarters, home of the Retirement Guys Formula and America's Medicare Associates and Retirement Tax Partners with Nolan Baker. 419-794-3030 is the phone number. It's 419-794-3030, online at arhq.com. My name is Chris Swan. Today on the show, some new things might be invading your 401k, and how can you lower your tax bill in retirement? All this and more, but before we dive into it, let me check in. Nolan, glad to be with you once again. How are you, sir?
Just enjoying the beautiful summer weather that we've had. Got a little hot, but you know what? I'll take it. Summer goes so fast, and only a few short weeks till my son moves down to Florida. So trying to get in as much time as we possibly can, having some fun time enjoying the summer.
Certainly making the most of it, and it's hard to wrap my head around the fact that it is already August, but I mean, the calendar doesn't lie. But appreciate you taking time out of your schedule in the summer to spend with the listeners here. I want to start off by talking about the fact that meme stocks, they're back. They're called memes because the popularity is due to discussions on social media, like GameStop and AMC from a couple years ago. Well, this time it's names like Kohl's and Open Door, but options trader Tom Sosnoff reminds CNBC that if it looks like a duck, well,
let's be real about what they're moving. You know, this is a $1 or $2 stock that's trading at 3.5. But the reality of it is it's still a rinky-dink little stock. So what you're looking at right now is just a lot of noise, and traders are looking for noise. They're looking for action. They're looking for opportunity. I think that's the pull here.
Now, Nolan, I doubt that any of your clients at America's Retirement Headquarters are playing the meme market, but what advice do you give on how to pick stocks?
Well, having $500,000 saved up for retirement and not knowing what you own really is not a plan. If you feel like maybe you're just getting generic portfolio advice, you really could benefit from having 5 simple stock picking rules that matter, and really an approach maybe to have some individual stocks in the portfolio. And what I'm going to do is I'm going to share the exact framework that we use for picking stocks for our clients. Without that framework, that's how people get caught up into the emotional roller coaster that you can see from the noise of like social media, meme stocks, news headlines that, you know, create fear and doubt in your mind of what you own in your portfolio. And, you know, creating that uncertainty can be a costly mistake. So having this framework today is going to help you take and hopefully reduce and or eliminate some of that short-term market noise that you hear. So the step number 1 is looking at financial stability. That's one of our rules that we have when we look at stocks. And do you feel comfortable, I guess, investing in financially sound companies, or is it okay to try and jump into hot stocks that maybe are the topic of a recent social media ad? You know, for us, buying hot stocks seems kind of appealing. You know, it can be fun to talk about at a cocktail party or with some friends that you have, but it can be very risky just by chasing the hot stocks that are out there. If we look at things like some of the electronic vehicle companies, you know, we had Fisker and Nikola both filed bankruptcy. So what was considered to be a hot company or hot area to get into, those 2 companies went out of business. There's kind of 2 ways that I feel an investor loses money when it comes to investing into the stock market. Number 1 is you buy an investment, it goes down in price, and then you sell that investment and you lock in a loss. And you do that because of an emotional decisions that you have about the company. That's one way that you lose money. You know, hopefully if you know what you own and you know the reason why you bought what you bought, if you look at when prices go down, that could create an opportunity, not a reason to panic. But the second way that you lose money is when you invest in a company and they file bankruptcy. I have a client, and he recently worked at Rite Aid. And as you know, Rite Aid had recently filed bankruptcy. So not only is that client now retired, whatever Rite Aid stock he had, say, in his 401k, because of the bankruptcy, is now really worthless. So those are 2 different ways. So when we look at it and we're looking at the companies that we have and we're looking at what companies do we want to invest into, for financial stability, what we're doing is we are looking at companies that typically have greater than 15% or greater than $1 billion of cash in their bank account. So that's one of the cash requirements for being financially sound. And then we also look for companies that have less than 30% in long-term debt. So cash-rich, low-debt companies are the financial stability ones. The second thing that we take a look at in this category is looking at companies that have a high profit margin. If you think about, say, the past 10 years, dividends can account for anywhere from 15 to 20% of the total return of the stock market. So investing in profitable companies can help put you in a basket of companies that have the potential to pay more in dividends. The difference between hoping and stock appreciation versus getting that regular income is a good way to look for those companies that have that 15% or greater return on equity margin. It shows that they're generating strong profits for shareholders' money. It means they could afford to be more consistent with their dividends than forcing you to hope for stock appreciation over time. Third thing that we're going to take a look at is we're going to look for companies that have a competitive advantage. So for the competitive advantage, we're going to look at companies that don't necessarily have to compete on price alone versus those that do. What happens when you have companies that have a competitive advantage, they typically can end up having, better profit margins. And again, not just competing on price alone. That competitive advantage also can keep clients loyal even when some competitor offers a lower price, meaning that they have the ability to charge a premium and maintain higher profit margins without losing business to competitors. Then we're also going to look at companies that are what I would consider to be daily essential. The difference between companies that are the needs and wants. If we have tough economic times, there's certain bills like my housing, my transportation, my food, my energy and utilities. These are all things that I'm going to pay regardless of what the economic conditions are. But then there's other things in other companies that are more of the wants category. And in the wants category, if times get tough, I don't need to take my family on a cruise next year. I could maybe do a staycation versus a vacation. Those are the type of companies that tend to be a little bit more risky when we get into economic tough times. So focusing on some of those daily essential companies can help when somebody has the ability to change what their discretionary spending is. Think about the things that you're not going to cut when you go into a recession. Those can help provide some more stability as well. So again, if we look at the 5 formulas that we use here at the Retirement Guys Formula and rules for identifying financially strong companies, we want to look at companies that are, number one, cash rich. They have higher than $1 billion if they're a large company in the United States in cash. We want to look at companies that have low debt. They have less than 30% of long-term debt. We want to, third, look at companies that have greater than a 15% profit margin. Fourth, we want to look at companies that have a competitive advantage. And fifth, and/or, would be companies that are needed on a daily basis. And if you put all that combination together, it's going to allow you to take a look at, what you own and have a better understanding. You can go over, and there's some good websites that you can go to, like Morningstar. You could go to Yahoo Finance. If you don't know what you own, or if you want to find out, do the companies that you own currently, do they meet those 5 criteria? That's where Morningstar or Yahoo Finance will give you the data on those different companies that you own. Now, if you own like a mutual fund or you own an exchange-traded fund, it takes a little bit more research to truly find out what you'd own. You'd have to go and look at the portfolio and look at the actual holdings and then do the research that way. But those are 2 good tools, Morningstar and Yahoo Finance, to do the research. If you find that confusing and you still just want to know what you own, you can always get a hold of us here at America's Retirement Headquarters. Just ask us for an independent portfolio analysis. We can put that analysis together for you and send over exactly what you own in your portfolio so you'll know if your investments meet those 5 rules that we use here at Retirement Guys Formula.
And those rules are a longstanding methodology that the Retirement Guys Formula has utilized. I remember having this conversation back in 2020 with you, Nolan, and hearing the same rules. and talking to other members of the team and hearing the same thing. So you get that consistency in the message. Now, the components inside may change from time to time, but it is something that is pretty much tried and true with the team at the Retirement Guys Formula. To find out more, to see how your investments measure up, set up a time to speak with them. Go to arhq.com or give a call, 419-794-3030. Nolan, in the first half of this year, sales of annuities topped $200 billion. People getting ready for retirement like the idea of guaranteed income and some protection against volatile stock markets like we've seen earlier this year. Barron's posted an article about something called MYGAs, which stands for Multi-Year Guaranteed Annuity. I know annuities is always an interesting discussion when it comes to people's retirements. Nolan, can you explain what MYGAs are and how you potentially use them for clients?
Multi-year guarantee annuities really have kind of surged in popularity in probably the last 18 months for several key reasons, driven really both by economic conditions, some of that investor psychology that's out there. But here's why retirees and advisors are embracing them more than ever. Number one, you can get high guaranteed interest rates. And a multi-year guarantee, what you're talking about is an interest rate that's guaranteed by the insurance company. So, we'll take a look at how to look at the ratings of companies because the insurance guarantee is backed by the company that's issuing it. And if I look at it in 2025, many A-rated insurers are offering rates right now as high as 5 or 6% for 3 and 5 year multi-year guarantees. We have had a lot of people that have called into the office. Andrew Baker, as part of our team, he runs our fixed income department, and he has just been actively looking at trying to help either upgrade people's existing accounts that they have to where these higher interest rates are today, or he's talking with people that maybe have some lazy assets, is what I'll call it. Maybe it's a lower interest rate CD that matured. Maybe it is money at the checking savings account that they want to earn a little bit higher interest rates. But, really when I look at annuityratewatch.com and I look at all the top rates for, A-rated insurance companies, again, there's multiple different companies right now that are in that 5 to 6% rate for contracts that are anywhere from 3 to 5, even to 7 years. The rates are pretty attractive. And when you compare those rates to things like CDs or treasury yields, I think the popularity that you have in the multi-year guaranteed annuity space right now is because of the high rates that they have right now. You don't have stock market risk that's associated with it. And if you have money that's non-retirement account, you're also getting the tax benefit of tax-deferred growth, which you don't necessarily get that on CDs or treasuries or savings account. You still have to end up paying taxes every year, even on money that you don't spend. So number two is you have the desire for safety and stability. Again, I think with the record inflows that we've seen, it is because investors in the market are maybe looking to pull off some of their winnings that we had, after 2.5 years of strong growth that we've seen in the equity market. And look, I think equity investing is great. I have equity investments. My clients do as well. But, protecting some of the profits, I think, has been important, when people have experienced like the volatility that they saw back in COVID or, in the 2022 environment, when we had inflation, some concerns, heck, even earlier this year when we saw the quick volatility that we had in the stock market with the tariff wars, many retirees are continuing to prioritize having some of that principal protection that they get. And those multi-year guarantees, they do provide that with no exposure to market risk, no bond market risk, making them ideal for risk-adverse investors. Number three is, I think, the aging baby boomer population. We've got one of the largest waves of baby boomers that are moving into retirement time. And so they're going from this grow your retirement accounts to now wanting to retire and have more predictable income. Those multi-year guarantees, they can meet some of those short-term, those mid-term income needs, developing a structured plan. An approach that we use called the independent income system, we use those different buckets of money to provide, reliable income. We can use it to provide a future pay raise as well, because if you have a known guaranteed interest rate, what that account's going to be worth in a couple of years from now. Number four is you do get, as I briefly mentioned before, that tax-deferred growth. That's relevant for non-retirement accounts. And for non-retirement accounts, deferring those taxes until a later date, until you take the withdrawal, can be very attractive when you compare it to getting a 1099 and paying taxes on your checking, savings, money market accounts, CDs, treasuries, those type of investments. Delaying taxes allows for a little bit more of the compound growth. You ultimately want to try to get over into the tax-free category as much as possible, but the annuities are tax-deferred investments if used in a non-retirement account. Number 5, it could be a better alternative in a bond environment, especially in a volatile market. We've had a lot of talk of interest rates and, where interest rates are going to go in the future. Interest rates are dependent upon where the inflation factor is in. I know the president also has put a lot of pressure on the Federal Reserve to try to cut interest rates. So you have interest rate risk and uncertainty, where in a multi-year guaranteed, you're not going to have those type of fluctuations with your account value, like, bonds go up and down based upon whatever it is the auction price that day. So a lot of advisors are then turning to these multi-year guaranteed as a fixed income alternative. It's giving you that bond-like exposure, so your fixed income part of the portfolio, you don't have the duration risk, you don't have the price volatility, and you don't have those advisor management fees and expenses, so it can be a better cost option as well. And number 6, I think, more advisors and consumers are becoming aware of what multi-year guaranteed annuities are. Insurance companies and the independent marketing organizations that are out there have definitely, heavily promoted what multi-year guarantees are, what fixed annuities, what fixed index annuities are. Many advisors, I think, are acting as a fiduciary, understand that using a multi-guaranteed annuity as part of a diversified investment plan can be better than, say, pushing a variable annuity or some type of proprietary fund that's offered from their company as well. So a multi-year guaranteed annuity, again, is a type of product that offers a guaranteed interest rate for a specific period of time. They typically can range anywhere from, 3 to 10 years. It works similar to like a CD, except a CD is FDIC insured. An insurance contract like a multi-year guarantee is not. It's backed by the insurance company itself. And then, of course, whatever state you purchase it in typically has some type of state guarantee in place in the event that the insurance company becomes insolvent. And multi-year guarantee is good, again, if you're looking for principal protection, if you're looking for a set fixed interest rate, you want tax-deferred growth. You don't have to worry about market volatility. You do need to pay attention to a couple different things. Number 1 is surrender charges. So surrender charges are the penalties that are going to apply if you take your money over and above any type of free withdrawal that's available. So some contracts have no free withdrawals. Other contracts allow you to take interest that you earn out of the account. Other contracts allow you to take out up to 10% per year for free after the first year. But if you take out more than that, you would pay some type of penalty. So you got to make sure that you're picking something that makes sense for your time frame. And, retirement, it can be, a good alternative to get a little bit higher interest. Can be a way to kind of bridge some of your income gaps that you need. Can be part of a bucketing strategy of diversifying your portfolio. If you want to watch the topic on that, watch my video on the independent income system, where I'll walk you through where there could be some opportunities to incorporate some of these into your portfolio. Where you probably don't want to look and consider using multi-year guarantees is if you want full liquidity, probably not the right product for you. If you want to have more growth and be involved in the stock market, it's probably not the right type of product for you. If you're in a low to no tax bracket, the tax deferred growth may not be something that's important. And then you want to check out, what the financial rating is from the insurance company. But when you look at all of those, again, if you have lazy assets, if you have money that's built up that you think you want to make that money work a little bit harder, as of recording this right now, when I look at our annuity comparisons that are out there, there's multiple great rated companies that offer, A ratings from what their financial health is, that offer anywhere in that 5 to 6% range. So a lot of good choices that are out there today. of making your money work a little bit harder.
When it comes to annuities, whether they're fixed index or multi-year guaranteed, they're not right for everyone out there. You want to make sure you do your due diligence. The team at America's Retirement Headquarters, when you sit down and speak with them, they'll have that conversation. And if they believe that this is something that could be of benefit to you, they will let you know that. But just do know that they're not going to steer you into one direction or another just because that's what they do with everyone. That's not the case. So to find out if this sounds of interest to you and you want to find out if this could be a valuable part of your strategy, set up a time to speak with them. Go to arhq.com or give a call 419-794-3030. The 4% rule regarding retirement withdrawals has been around for 30 years. Finance personality Dave Ramsey calls the rule ridiculous. He says people should be able to take out more based on a 12% annual return for mutual funds. Personal finance guru Susie Orman calls the 4% rule dangerous and says people should only withdraw no more than 3% a year if they're retiring in their 60s. Who is right here? Nolan, how do you feel about a rule that is governed by percentages?
Well, figuring out a safe withdrawal rate in retirement is really about understanding kind of the approach of how to, put things in place. When we think about a lot of the rules that are out there, there's the 4% rule, which is pretty common in the industry. Dave Ramsey talks about the returns of the market being 12% over time and saying that you have the ability to take much higher withdrawals. You have Susie Orman on the flip end of the scale where she's talking about, the 4% rule is dangerous, maybe considering no more than 3%. And with the fear for the majority of retirees saying, I don't want to live and outlive my money, I can understand trying to figure out, what could be a safe withdrawal rate. And in the next 7 minutes, I'm going to show you exactly how to do that. So in the first step, what you want to do is step number one is total up all of your financial assets. You want to add up everything like your IRAs, your 401ks, your CDs, your Roth account, your brokerage, your savings, your checking, annuities, any pensions, and if they have a lump sum value associated with them. It's what I call creating your financial inventory. And, for today's purpose, we're going to say that number totals $1 million that's saved up. The next thing that you want to do is you want to estimate what your annual spending needs are. And I want you to break it down into two numbers. Number one is what are your essential needs? And number two is what is your ideal income in retirement time? So when we're looking at your essentials, I want you to add up your housing, your food, your transportation, your healthcare, your utilities. So this number that you have right there, that number you have to have covered, in my opinion, when you move into retirement time from reliable income sources. The second number is your ideal income, and your ideal income is going to be all the fun stuff that you want to have in life, right? Your discretionary spending. So those trips and vacations, maybe it's the new shed that you always wanted to put in the backyard or a new hobby that you're going to start, spend more money on golf, things like that. You want to look at, number three, considering shifting money from your risky assets to reliable income to cover those essentials. Using the example that we talked about, let's say that particular family needed $50,000 to cover their essential income, and their ideal income was $80,000. If looking at their reliable income source, let's say they don't have a pension, so their reliable source of income right now would be Social Security. So let's say Social Security is $40,000. If you take $50,000 that's needed minus 40, there's a $10,000 gap of what their essential income need is. And so what you do is you take and you can shift some money from the $1 million portfolio and use an investment vehicle that would provide that $10,000 a year. There's two different ways that you could do it. You could buy an investment that pays a fixed rate of return for a set period of time, and you know that would be covered, right? So if you needed $10,000, you could simply do the reverse math and say, here's the interest that I need. Here's how much I needed to deposit. The other vehicle that's pretty popular with a lot of retirees are income annuities. So some contracts that are out there will offer you income, and that income you can typically get from an insurance company guaranteed for the rest of your life, regardless of what the account value does. And you can go with a single life, or if you wanted to protect your spouse, you could go with a joint life option as well. So in our example, that couple, they needed to shift, let's say, $150,000 into an income annuity to generate that $10,000 gap of coverage that they have. Now they have the essentials taken care of. If you are going to do that, I would say it's very important if you're talking or somebody is talking to you about an income annuity to make sure that you ask that they provide you with a printout of the top 3 offers from the insurance companies of America. So don't just go with what one company is, talking to you about. You want to compare the rates of the top 3 companies because they can vary dramatically. And then you also want to understand that even though you're getting that income guarantee, how is the investment vehicle actually working that's underlying that product? Is it a fixed index annuity? Is it a variable annuity? I tend to prefer having fixed index annuity. So with the money that's left over and that money, then what you could do is you could figure out what a reasonable withdrawal rate is. I think, conceptually that 4% withdrawal rate makes a lot of sense. As you get older, or if you have stronger guaranteed income sources by following, again, like this advice, I think then you could have a little bit of a higher withdrawal rate, maybe 4.5%. So using that same $100,000, if they shifted $200,000 into income producing vehicles, that left them $800,000. And using that 4.5% withdrawal rate would equal about $36,000. Thus, in this example, this couple could have income of about $86,000 when you add the $36,000 plus the $10,000 from the annuity income, plus the $40,000 of Social Security income. Don't forget, as you're running these factors, though, keep in mind you got to take into consideration planning for the potential of higher taxes in the future. You also want to build into your plan ability to fight off inflation over the long run. So idea to consider is using a dramatic, dynamic, flexible withdrawal strategy, meaning that you can adjust your withdrawals based upon what the market does. Those years that the market performs a little bit better than expected, those would be years that you could spend a little bit more. Trying to spend your profits, not your principal. In those other years where your market performance is higher, maybe shift more money into providing you a pay raise or adding in more of an emergency account as well. So it's really not a magic number, but it's figuring out in your situation, how to develop a withdrawal strategy, how to figure out what your income needs are, both ideal and essential, and developing that plan that can get you away from constantly worrying about running out of money. And that's exactly what we do here at America's Retirement Headquarters.
Because everyone's situation is different, there is no one magic number for everyone, a withdrawal rate. And truth be told, that withdrawal rate is going to vary from year to year, as Nolan pointed out there. But if you have a plan in place, you can calculate, recalibrate as necessary. It is a bit of moving parts, but the team at America's Retirement Headquarters can help you create and maintain that plan. Just reach out and set up a time to speak with them. You can go to arhq.com, find out more about the team at America's Retirement Headquarters, arhq.com, or you can give a call. The number's 419-794-3030. Welcome back, and thanks for joining us here on America's Retirement Headquarters, home of the Retirement Guys Formula, America's Medicare Associates, and Retirement Tax Partners with Nolan Baker. 419-794-3030 is the phone number if you have questions about things that we've talked about this week on the show, or just questions about your retirement in general. If you want to know more, that's the number, 419-794-3030. You can also go to the website, and that is arhq.com. It seems like we sometimes make a big deal out of trying to guess when the Federal Reserve is going to cut interest rates next. JP Morgan's Jack Manley tells CNBC that it really has no bearing on the economy overall.
The Fed has a lot less control over the economy than it thinks it does. It's got a boatload of control over asset prices. And it makes a move on its balance sheet on the short end of the curve, and it can dramatically alter values for stocks, bonds, real estate. But CPI, inflation, actual GDP growth, this is an economy that seems to be almost agnostic to rates.
Now, Nolan, do you agree, interest rates may or may not affect the economy, but can they have an effect on someone's retirement plan?
Well, earning 2 or 3% less interest on a $500,000 portfolio, let's say over a 15-year time frame, can be massively costly mistake by missing out on that extra interest due to the power of compounding. And here's exactly, how to look and what it looks like. Even a small difference in interest rates or returns, just as say 2%, it could cost you 6 figures over the next 15 years. And so what we want to do is we want to make sure that every dollar works as hard as possible for your future. So if you have 15 years and you look at the growth of a $500,000 portfolio compounded annually, 5% interest rate over that 15-year time frame would grow to be worth $1,039,463. If you earned 3% interest on that same $500,000 over 15 years, it'd grow to be worth $778,497. So, the difference of that is $260,966 difference compared to the 5% rate. Or let's just say that you have money that's earning only 1%. That 1% rate, $500,000 over that 15-year time frame would grow to be worth $579,568. That's a difference of $459,895 compared to that 5% rate. When you're shopping for high fixed rates, whether it's CDs, whether it's multi-year guaranteed annuities, or whether it's bonds, it requires more than simply just picking what the highest yield is. You need to really kind of have a good step-by-step approach on how to maximize those returns by taking a look at them. This is another area that is just really impressive with where technology is going. I know we had got a phone call last week from a gentleman who had called our office, and he was asking about a particular fixed rate that he had found and wanted to see if our office could help him set up that type of an account. And of course, we were more than happy to help him out. But I had to ask him, I said, well, where did you find that rate in particular? Like, how did you find out what that rate was? And he went on to ChatGPT and he asked in ChatGPT, who has the highest 3-year and 5-year fixed rate annuity and multi-guaranteed annuity. And ChatGPT actually was able to come back, search the internet, and give him some results. So amazing where that technology is going. A word of caution, though, is he did ask about a couple of products that ChatGPT had mentioned. And what I explained to him is you got to really kind of read the fine print on that. That one product in particular that offered an extremely high rate, that rate was only good for the first year, meaning that the rate most likely would be substantially less in the following years. It technically was a 7-year contract. So that's a good way to look at them. And I think when you're shopping for fixed rates, what you need to know is what you're shopping for, right? So when you get a CD, it's good really, I think right now for your short-term money that you want to have backed by FDIC insurance. People are typically getting CDs anywhere from 3 to 5 years. Most of the CD rates that I think are out there right now in that 3 to 1 or 2 year time frame tends to be kind of the sweet spot as what you have. In a previous segment, we had talked about what is called a multi-year guaranteed annuity. A multi-year guaranteed annuity is an insurance product. It offers tax-deferred growth and is typically good for people that are close to or in retirement time. And it usually is for investments that you want to set aside anywhere from, say 3 to 10 years. So if you bought a CD for 1 year, at the end of 1 year, when that term matures, you're going to get whatever the current interest rate is that they're offering. So somebody who bought a CD, let's say a year ago today, the rate was higher a year ago on CDs than where rates are today. So now the rates are lower. If you bought a multi-year guarantee, let's just say you bought a 5-year multi-year guarantee, that rate is going to be locked in for that 5-year time frame. So it's going to be something that you're not going to have to worry about the change interest rates over year by year, as long as you locked it in for that multi-year guarantee. The next type of product that you can get with fixed rates is treasuries. With treasuries, those are good really for safety. They're good for liquidity. They're government-backed. You can have those and they range anywhere from 1 to 30 years. And sometimes you can get some benefits like, state tax-free income. And then the fourth category that you'd have would be fixed index annuities. And those are the ones that people are looking for principal protection plus the ability to participate in the growth of an underlying index if that goes up. And most of the vehicles that I see for fixed index annuities tend to be in that 5 to 10 year space as well. You do want to compare apples to apples. You want to look just beyond the headline. Like I had mentioned, the person who typed it in ChatGPT, I think that was good to get his mind thinking about what the rates were that out there. But as I had mentioned, the one product that had the highest rate that he found on the internet, that was just a first year, what I call teaser rate. Usually if you're going to get a high multi-year rate, you want to lock in that rate for a set period of time. You want to look at, any type of fees and charges that are out there. For example, some of the insurance products, you could have liquidity riders. You have the ability where you could add in things like chronic illness benefits. You can add in income riders. You can get products as well that are just no fees and pretty straightforward as well. But you do want to, consider any fees or charges that you have. You want to know, is that rate fixed or is it adjustable? And it's fixed. Is it fixed for the length of term of the contract, or how long is that rate fixed for? If you do have an insurance contract, you want to become familiar with what surrender charges are, how those early withdrawal penalties could work, and understand the difference between those. Number 3 is you want to prioritize what the financial strength of the company is. You want to check the financial rating of the company. Check it with like AM Best, S&P, and Moody's, looking at the financial health. If you're going to invest in a fixed income like a bond fund, you'd also want to look at the rating that you have as well. So, if you have a bond fund, you can go to a website like Morningstar, and then you can click on portfolio. And on the right-hand side, you'll be able to see kind of like what the allocation is and of A or B rated type bonds. And keep in mind that the lower the rating, they typically pay you higher, but the more risky that investment could be, whether it's a bond or an annuity. Avoid chasing the highest interest rate. That could be kind of a dangerous move as well. And, for banks, you just want to become familiar with what your FDIC insurance status is as well. So you then kind of want to go through some of those trusted sources. Again, I mentioned the gentleman who used ChatGPT as a starting point, but there are companies you can talk to, agents like our office. I can go on a website called annuityratewatch.com, and I can typically search 500 different products all at the click of a button and find out based upon what somebody's terms are and what they're looking for, and knowing, what some of the rates are that are out there. There's also websites like bankrate.com and other different organizations or agents that you can work with where you can get rates. If you're looking for treasury rates, the website is treasury.gov. And then, matching your duration for what your time frame is. So if you have more time, usually you typically get a little higher interest rate if you're willing to put that away for a little bit longer time frame. So make sure you understand what you're getting into. Again, don't chase yields or interest rates blindly. Understand, what the financial product is. Understand what the flexibility is that you need. But again, in our example, high fixed rates can make a massive difference. The difference between a 5% fixed rate or a 1% fixed rate over a 15-year time frame is nearly half of the money difference, growing from $500,000 to over $1 million to earning only 1%, only growing to $579,568. So put your lazy assets to work. Fixed rates are fantastic right now, and that's how you find high fixed rates.
While we certainly can't control what the Fed does, and I think a lot of people wish that they could, including, those in the White House, we can control how to take advantage of these rates as they stand right now. And Nolan just gave a great example there to see how they can work for you. Set up a time, have that conversation with the team at America's Retirement Headquarters. Go to arhq.com, set up a time there, or give a call, 419-794-3030. As always, we want to thank you for joining us here on America's Retirement Headquarters, home of the Retirement Guys Formula, America's Medicare Associates, and Retirement Tax Partners. With Nolan Baker. Really do appreciate it. Hope you have a great week ahead of you. You stay safe out there. Nolan, always appreciate the time. As we wrap up, I want to leave you with the final word.
Yeah, as we move into August, we think, back to school. We think summer's is kind of coming to an end, but we still have a little bit of time. Still have some great opportunities to get out there, enjoy the beautiful weather. I hope you have a wonderful week, and we'll be back next week here on Toledo's largest talk station, 1370 WSPD. Giving you more great retirement advice. And just remember, when you think retirement, think America's Retirement Headquarters. We're here for your entire retirement.
America's Retirement Headquarters is located at 1700 Woodlands Drive in Maumee, Ohio. You can reach them by calling 419-794-3030 or online at americasretirementheadquarters.com. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Nolan Baker is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstance. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Nolan Baker, Ohio Insurance License Number 27787.